Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey, everybody. So let's talk about some ideas. We've had a really big sell-off out there, and I've got a list of my favorite names put together. And I wanted to talk about a few of them because I think this is a world of intense disruption. I think we have to be aware of the kind of environment that we're in, but also have a little bit of a premonition for what the environment's going to be like as AI evolves. And I think particularly in certain areas, there is more and more disruption. So, companies and areas that sort of formerly had these really wide moats and sort of long runways of potential success, I think things get a little bit shaky here with some of these new technologies. So today I want to talk about Uber, one of my favorite stocks. It's been one of my favorites for a while. It's quite volatile. It's got a very high beta to the market, 1.3-ish around there. So it goes, it moves to the upside, it moves to the downside. I've, done some covered calls. I've done some sort of income strategies in between. But for the most part, I really don't want to get in the way when I believe it finally fulfills its destiny and keeps going. So great. Of course, everybody knows Uber, ride hailing market share. Basically owns the lion's share in North America. Lyft has a little bit, surprisingly, even that much. You almost never see them, but that's the amazing thing about Uber. It's that brand, right? It's like Kleenex. Nobody says, "Oh, grab me a Scott's tissue or whatever." It's grab me a Kleenex. It's our our everyday kind of chit chat. So launched this ad part of it, which I think people don't ever talk about, which I think is one of their secret weapons, is it launched in October 2022, this advertising revenue. They've built this up to $1 billion a year, which I think is powerful for Uber because it can fund other things that they want to do. It's sort of a little kind of secret stash of cash that they have. So really kind of a cool thing that no one talks about. Global leader in ride hailing, 63% US market share, 171 monthly active users. So real big network effect here. Lots of people involved. It sort of feeds on itself, right? That's that network effect. The bigger something gets, the more adopted it is, the more powerful it becomes, the more cost efficient it becomes, et cetera. $65. We did see it in the low 60s today. Revenue breakdown, mobility. So that's basically, ordering something from your phone or maybe even from your laptop. That's sort of the typical ride share. Delivery is, of course, Uber Eats and things like that. And freight, I think, is a decent size, but I'm not sure it's really growing. I think it's sort of come down a little bit. And of course, this is sort of your global look of many, many other competitors around the world. But I think, Uber is certainly the biggest. And I think there's room for when you're that sort of big elephant in a space, you can kind of use that to continue to expand. So getting to be really big, not quite that sort of intense stranglehold on the industry that Netflix has in its industry, but perhaps heading in that direction, which I like. So big moat, network effects, more drivers. It's a more reliable product, right? If there are few drivers, then you don't really want to use Uber very much. But the bigger it gets, the more adopted, the more drivers you get, the more people are out there willing to do this job, the more it becomes a very reliable source for ride hailing. Scale, 72 different countries. They get those cost efficiencies, right? So the insurance costs go down. They have this sort of buying power for things. Uber One is that, I think it's about $9.99 a month. And actually really, really big adoption. We'll see that number, 27% of mobility bookings through Uber One, right? You pay this sort of monthly fee and you get sort of free delivery, you get discounts on your rides and things like that. So it can be worth it if you're using these things quite a bit. Autonomous strategy, partnerships with Waymo, Cruise, Robotaxi. So this is a big thing, right? This has sort of been the big thing where you've seen of late Tesla. Every time Tesla does well, Uber doesn't do well. Every time Uber has something positive, maybe Tesla sort of takes it on the chin a little bit there. I don't think it's as cut and dry as that. I think Uber is much more powerful in that space. Tesla is a formidable competitor, but I think kind of on the technology side of things, and I think that's going to be kind of years away. So But still, it's having an effect because, of course, that's disruptive to their very business, right? But I don't think in such a negative way. I think it's very disruptive to the drivers. I think at some point, I don't think it's going to be for 6, 7 years, but the drivers are going to have a bit of a tough time with that. But Uber, which is smart, it's kind of abandoned this sort of effort to do its own kind of autonomous vehicle technology, which I think is smart, right? You don't want to try to do something you're not good at. You want to stick to what you're very, very good at. You want to partner with companies that do those other things really, really better. That's really smart, especially in technology where life happens really, really. Uber, for example, with one of the relationships with Waymo, they handle the fleet management, they do the cleaning, the maintenance, charging, things that they're good at. And then Waymo focuses on the technology side of things. So really, that's kind of that symbiotic relationship that smart companies look for. And as of a couple months ago, they're partnered with Waymo, Cruise, Aurora, Avride, BYD, even that Chinese car company. And so really, really nice relationships being created. Tesla did not want to partner with them, so that's still hanging out there as well. So, but it can make a difference, right? So Waymo is big in Austin and Atlanta, I think. They are only bookable through the Uber app. That is a powerful, powerful relationship. They have obviously said, look, Uber's got the eyeballs. Let's combine with what they offer and make something great. So I think things are heading in the right direction with that. And robotaxis, I think, are a little further out from mass adoption, in my view, because we've had a couple crashes in the last few years. There was one in Las Vegas. There was another one that happened with the company called Cruise, and that got their license suspended. So you're going to really need this to be solid, solid, solid to have that public, that regulatory trust that is required for that to become really, really big. So I think it's going to be 6, 7, maybe even 10 years. And that's a lot of time for Uber to adjust and make all the right moves. Growth opportunities, robotaxi integration, as we've been talking about, delivery, big year-over-year growth, 14%, 13.2 billion there. One membership, we talked about that, 25 million members. It drives loyalty, right? When you get a points card for a gas station, you want to use that gas station more. Global expansion, still a lot of room there, I think. Let's keep going. Uber Eats, bookings, 74 billion 2024. Very, very popular service, right? They really have that. There's DoorDash, a few other ones, but Uber Eats, very popular. A million restaurants aligned with them in 11,500 cities. Tough times. So this is a good one, right? This is part of what I want to talk about with my list is that are we going into a different kind of environment? So I think we had evidence of that. That gives me encouragement. In the COVID pandemic, we had Uber rides really, really drop, but we had deliveries really, really pick up. It kind of has this sort of built-in hedge there, right? Deliveries went bananas. Everyone was at home. They were ordering stuff. So I think that's potentially happens again in more difficult times. And people eat home maybe a little bit more. They go out to restaurants a little bit less. I think that's kind of a really cool kind of built-in aspect to their business. Because there's no question, discretionary rides, you look at things like nightlife, airport, going on trips, things like that, that could decline. So still, we're not sure which wins out over time, but nice to have that little hedge. And then we're going to look at valuation. So here, I wanted to mention right off the bat, Uber trading at really the cheapest enterprise value to operating cash flow we've ever seen. So 21 times, where the average over the years is 51 times. Pretty amazing stuff there. Cash flow, of course, always important to me, almost always important to me, and certainly a nice to have. We can see that Uber did the old, expand, 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 invest, 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 get more drivers in order to expand that network effect, and then finally flip the switch. And they've gone very nicely cash flow positively. That 15.7 free cash flow margin, that is very, very impressive. So let's look at PE, 35 times forward, not cheap, but really nice growth. So that's not really too bad there. 16% free cash flow margin, pretty decent analyst sentiment, looking for 21 to 28% upside, a little bit higher depending on what the market's doing. Strong free cash flow, recession resilience, which we talked about. And I think if they latch onto this being a negative right now, when the market realizes that this could very much be a positive, that is going to be a real tailwind to the stock. So caution, of course, stock could be vulnerable to market correction. We talked about that beta being very, very high. At competitive risks, right? There's regulatory risk. Do they get the drivers? There's always talk of them being recategorized. I think a case got thrown out last year. Are they going to be recategorized from independent contractor to employee, which means you got to pay for health insurance, et cetera, et cetera. Of course, Uber's fighting that. And then some other impressive metrics. Uber's free cash flow yield, 4.6%. That is very, very impressive. I'll tell you right now, because S&P average is probably around 4%. Amazon's, which we're going to talk about in a few days, 2.8%. So it indicates that Uber's really quite cash positive relative to its valuation. And that's good for anybody in ride hailing, delivery space, and things like that. So very smart company, really set itself up for about 10 years and flicked the switch there. So that's a big free cash flow yield increase over the previous year, right? 3.36 billion to 6.9 billion. Very, very smart management doing the right things. So price to earnings growth, that PEG ratio 1.2 based on that forward P of 35, expected earnings growth rate of 29%. So that's impressive because anything kind of below 1.5, especially close to 1, is considered very attractive for growth stocks, right? It suggests that the stock is generally undervalued relative to its growth potential. Of course, this depends on the kind of market you're in, but if you take NVIDIA, for example, it has a PEG ratio of 2.5, right? Very high PE, slower growth expectations, really, and that thing's, to be honest, is really up in the air. So Uber looking really, really good there. And particularly, given the environment that could soften, right? NVIDIA being rather cyclical, Satya Nadella came out and said they may not spend as much on CapEx if the market really slows, if the environment slows. So very, very cyclical indeed. Price to sales ratio, 3.4. That's using the market cap of around 148 billion, revenue 44 billion. And that's really compelling, right? For a high growth company, that's pretty solid. Amazon's 3.3, which I really, really love. But again, way below AI stocks like NVIDIA, which trades at around a 25-time price to sales, which is very, very high. And some metrics, NVIDIA isn't too bad, but price to sales, very, very high. So that would mean that Uber is not super, super overvalued relative to its revenue. And that's pretty good. So overall, really, really good metrics there. Okay, so let's take a look. What kind of trades can we do here? Of course, you can go right out and just buy the stock. Okay, so overall, let's start with looking at, we can see the SPY here just for the broader market. We can see that SKU has really, really steepened, blown right out, even a little bit farther than that August sell-off. So this is the reality of what's probably feeding into many individual stocks. So, which means is, people are really positioning in those downside puts. They're very worried, very, very anxious about things, and that's feeding into some single names. So you see everything above the zero line here means that puts tend to be more expensive. Puts are more expensive than the calls, but that's not that unusual for Uber. You tend to get puts more expensive, except right down in here. So that's going to inform us a little bit as to what we could be doing here. Not showing as much here, but typically it's not super, super cheap SKU, right? Those puts aren't outrageously expensive. It's actually kind of a fairly sort of flattish line on this metric. On spot gamma, it looks a little bit more interesting, a little bit more of a smile to it. You can see how this looks like a smile. That means downside puts are expensive, upside calls are expensive. And then overall, of course, the level of implied volatility is just high, right? It's just high. We're going to take a look at bar chart right here. And we can see in gold, the implied volatility, basically the high of the year, which is reflected in that IV percentile, basically. Most of the time, 99% of the time over the past year, the implied volatility has been lower. So this is not inexpensive option pricing, so we have to keep that in mind. So for 30-day volatility, you might be looking at something like a put sale. So I could look at something like, if I wanted to create exposure to Uber, I'm going to look at a May 60. So we've got about a 280. So you could sell this May 60 put for about probably, I'd say 285, 290, maybe 285 to be safe. And so that's a nice little way to potentially get into Uber. That's about $6 lower than what we're trading right now. So this would effectively get you into Uber if you were to have that put to you around 57 bucks. But if it stays above $60 over the next 39 days, you're going to just collect that $2.85, which would essentially be about a risk of about 57 bucks. So you get paid about 5% for 39 days to basically take on that risk of owning Uber at $57. So you might figure that as, wow, Uber's, it's really come down. It rarely trades below $55. In fact, we see that it traded down to about 60 bucks not that long ago. And then last August, of course, it dipped very briefly below that. But 60 is a pretty good spot here, given this valuation. Maybe we could trade a little bit lower than that, but this gets you in at about 57 bucks. So, but in the meantime, the implied volatility, meaning that option pricing is high and that skews fairly steep. So you kind of get paid to wait and to basically take this risk on in a market that really isn't going, right? If this were a market that was really chugging along to the upside, this may not be enough for me. I may not sell this put. I may do something a little bit different, do one of my turbo trades, create some upside in a different way. But right now, with the market struggling, my MTI is quite red. In fact, it's zero and being pulled back by the volatility dampener. It's not great. So another trade that you could do, because my HV rank is fairly high, it's hitting that metric that gets me to want to be a little bit more defensive, which makes sense given the market that we're in and the movement that we've had in Uber. This is a trade where you might look at a vertical, right? A credit spread of some sort. You might sell the 60 in May and buy the 55. So if you could do that for about 285 and 170, then that's going to get you $1.15 for a $5 spread, right? So $1.15, 385 of risk basically on that. So $1.15 to 385, not too bad. And then you have a little piece of the strategy that you can play with, right? You're long that 55. So if the bottom falls out of the market, you do have the protection there, and you can actually buy that back at some point when you get to a certain level, certain valuation level, a certain level on the chart. That's that little piece of gamma that I like to own when things are moving around, right? When you have volatility, make sure you have something that can take advantage of volatility. So that's one of the reasons I like the vertical, because you get that extra little piece that you can play with. You can roll that leg down. You can do all kinds of things when you have a couple of legs to the structure to play with. So that's number two. Another thing you could do is you could say, well, look, I think this thing looks pretty great. Now, I wouldn't go out and be buying sort of May, June. I think those options are very expensive. So you're going to have a lot of Vega risk there, right? So if you went in, you wanted to play some upside in Uber, you might look at somebody, a retail trader might look at this and go, oh, you know what, I'm going to play May and I'm going to buy some 70 calls at whatever that is. The spreads are wide right now, but let's say we pay 325. That's a fairly high implied volatility, right? That's a 55 volatility, quite high. If you're not right and right soon, you're going to start eating some of that, right? Especially if volatility comes down. VIX is trading at 45. You have a lot of sort of Vega risk for one, where the volatility can come down. And if it doesn't come down too quickly, you're going to have a lot of theta risk, right? Your theta is going to be much higher when you pay a much higher implied volatility for something. So what I would do instead is to alleviate some of that Vega risk and theta risk, I would spread it out, right? So you could buy a 72 half and sell an 80, cut down on the cost of that to some extent, 72 half, even sell a 75 half, and create a little bit of a spread there, right? When vol's high, when skew's high too, that upside skew is a little bit steeper, right? So you definitely want to use that extra short leg to cut down on your Greek exposure. Now, another thing that you could do is if you really liked it and you saw this thing at 85 bucks, now it's trading at 60 or perhaps lower, you could go out and position yourself in a March 2026 call. What you might do is you go in, target maybe an 83 delta, which gets you into the 50 call. And this is actually what I did in one of my accounts today. So I picked these up for, I think it was 2150. So you could pick one of these up, let's say a one contract at around 2180. You probably get filled at 2180. Depends what the markets are like tomorrow. But let's say that's going to cost you about 2100 bucks, 2200 bucks. To put that on, that's going to give you the ability to control 100 shares of Uber, whereas normally 100 shares of Uber would cost you $6,600, right? 100 shares times 66. In this case, you're spending about a third and you control the same amount of Uber. Now, it's got an 83 delta. It's not going to move exactly like Uber to the upside, but it is going to give you increasingly higher delta as it goes up, right? That delta is going to go up as the stock goes up. And eventually it's going to, if it keeps going, it's going to act more like stock one for one. Now, right now, you do have a little bit of Vega risk because the March has probably pumped up a little, not much. The further out options rarely pump up too much, but it's probably pumped up a little bit. So you have a little bit of Vega risk on there in case they drop volatility and the market calms down at some point. But the assumption is that if volatility calms down, Uber is going to go for a nice little run to the upside. Ackman's involved now. There's some positive things happening. And as long as we don't get a massive recession and things get re-rated lower, then the delta that you own on this position is going to far outweigh the Vega impact from the volatility dropping, right? So you can kind of think of it that way. Sometimes you have a little bit of a risk, but you have to think of it in the context of, well, what is my overall goal here? My overall goal is I think Uber is going to go to $100, and so a little bit of Vega risk isn't going to be a big deal for me. So there are a couple little things that you can do. Short cash secured put, a credit spread, a bull put spread. You've got a long call or a long call spread, and more like a leap to the upside to play something a little bit more, perhaps a longer term orientation on that leap. But there's nothing to say that if this thing rallies $20, you can't sell that out. So it's not to say you're going to hold on to this forever. It's going to give you a little bit of a harder delta, right? This isn't in the money. You've got some intrinsic value, you've got some time value, some extrinsic value, but this is going to give you some real punch for upside if and when the upside comes. So different ways to play Uber, a company that we've gone over I think is a really, really solid company. So hopefully you guys learned something from that. We'll see you in the next one.